While my video 101, we discussed the safety, liquidity, purpose, profitability, diversification, and security. While this video series 102, let us now discuss 5 C's of credit. Here again, the reference is the principles and practices of banking, module B, functions of bank, unit 22. In this channel, various credit lending topics based on JAIIB and CAIB latest syllabus will be discussed in simple language through small videos. It is certain that those who read and understand the topics covered in the videos will find it very easy to appear in the JAIIB and CAIIB examinations and also in the Diploma in Banking and Finance examination. An ideal advance can be considered as one which is given to a borrower for an approved purpose in which the borrower has the required capacity and experience to run the business and has provided adequate security to the bank. Even if all the parameters for a good advance have been fulfilled, the advance could fail due to various other reasons. The borrower is unable to generate adequate income and profit as envisaged. The borrower may be dishonest or not willing to pay. The external factors might have reduced his income and profit. Safety of the loan depends a lot on the credit worthiness of the borrower. The success of a lending decision depends upon the timely recovery of principal and interest. The risk of default is influenced by the 5 C's of credit or lending. They are character, capacity, capital, collateral, condition. Let us first understand the character. Character is a person's inner quality of integrity, stability, and honesty. Character is the most important element in credit soundness. Character refers to the customer's willingness and determination to meet a loan obligation. Usually, bankers tend to focus more on the technical and commercial viability of the loan proposal. While these aspects are very important, the men who are behind the project and make it succeed are also equally important. The best of projects can be badly implemented or mismanaged, while even risky ventures could be made to succeed through commitment and good management. It is difficult to judge the intentions of the borrowers. However, a lender has to make a judgment on the character of the promoter, namely whether he is dependable and has commitment to make the project successful and repay the loans. Bankers rely on their experience with the borrower, his past track record of honoring his commitments, not only to banks but also to others with whom he deals with, such as suppliers, contractors, government departments, etc. Due diligence by way of understanding the past record of the borrower through detailed enquiries with people who have dealt with him or who know him is the only means available to check on the character of a borrower. Capacity. A capacity of the borrower means his ability to manage his business in a successful manner. While the character of the borrower may be impeccable, his managerial abilities may not be adequate to run the business successfully and the risk of default increases. To a lender, capacity represents the ability of the business to bring in funds as and when required without depending on the bank alone. To generate adequate profit from the business to service the debt. To run the business successfully by managing the staff, suppliers, buyers, lenders, etc. Now comes the third item, the capital. The promoter's contribution in a business is known as capital. Capital indicates the financial resources of the borrower. The promoter's own contribution is also known as margin money. The borrower must have his own stake in the business, which will motivate him to work with initiative and interest for the success of the business. If a borrower needs rupees 100 as working capital and approaches a bank for working capital finance, bank may insist on a margin, say, of 25%. The borrower brings in 25 as his capital, which is his margin. The bank will provide the balance as working capital finance of rupees 75. Collateral. In spite of good management and a success business model, business may fail due to extraneous reasons which are not in their control, such as change in government policies or development of new technology, etc. In the event of failure of business, the lenders will have to take recourse to the assets of the business to recover the loan. Banks take additional security of assets from the borrower other than those financed by the bank as a safety net to provide for such a contingency. This additional security is known as collateral security. The collateral security can be in the form of land, building, flat, shop, ornament, insurance policies, shares, debentures, bonds, etc. Conditions. Conditions are the external variables that are likely to affect the business and thus its profitability. This is likely to have an impact on the loan and the quality of the loan. Banks have to assess the business model, the conditions of the economy, level of competition, demand bar supply situation, technological changes, impact of foreign trade policies of the government, etc. In assessing conditions, the lender determines whether the prevailing conditions are conducive not only for lending but also for borrowers' ability to repay the loan. So we have completed the 5 C's of credit: character, capacity, conditions, collateral and capital. Subscribe to my channel, which is totally free of cost. Subscription will give you intimation on the new videos published. More videos based on JAIIB and CAIB syllabus based on credit topics are to be published. Thank you very much. YouTube channel NPIS Learning Modules on Lending. Thank you very much.